Welcome back to part B of this lecture. This is where we will review the costing terminologies and the value chain, as well as variable costing and absorption costing. So we will be focusing on learning objectives 4 and 5. Our focus in learning objective 4 is in recalling the segments of a value chain and the different costing terms that are important in product costing as well as managerial control. So let's start with what exactly is a value chain. Well, it's a set of linked value creating activities ranging from securing resources and ends with providing and supporting products or services that a customer value. So the various cost classifications can be used within the upstream, downstream, and manufacturing areas to assign the cost to products in order to help manage resources and create value. So as you can see here, the value chain starts from securing raw materials and other resources. Then it goes on to research and development and product design. And where does it end? It ends with providing the products by what? By distributing it to them, marketing it to them, and by providing customer service in form of warranties, support, and the like. So the value chain really has the upstream. So the upstream are your research and development, product design, supply costs, and the like. And the downstream cost would include your marketing, distribution, as well as customer support or customer service. Now, manufacturing costs, the one that is right up here in red. All right, manufacturing costs are incurred within the factory area, whereas the upstream costs as well as the downstream costs are sometimes called non-manufacturing costs. Under the conventional product costing, only the manufacturing costs are included in product cost. So that means only the production costs. All right. Production costs are the one we consider as assets, whereas all the upstream and downstream costs are non-manufacturing costs, and they are normally referred to as period costs or expenses. So let's focus on manufacturing costs. These are the product costs, and like I said, they are assets. Why? Because they are those costs that has future economic benefit. So what are these product costs? This includes direct materials, direct labor, and manufacturing overhead. So what are direct materials? These are the materials that is physically incorporated into the finished products and can be traced to products conveniently. Whereas direct labor are the cost of wages and labor on costs of staff who work directly on manufacturing a product. So the carpenter, for example, who works directly in the manufacture of, say, tables and chairs will be considered direct labor, including on costs. So if you give this carpenter superannuation and other benefits, then that on costs will still be part of direct labor. Now, manufacturing overhead are all manufacturing costs other than direct material and direct labor. So they may include indirect materials, they may include indirect labor, as well as the depreciation of the factory, the insurance, utilities, all the manufacturing costs that are incurred in the factory will be part of manufacturing overhead as long as they are neither direct material nor direct labor. All right. You can see from this picture the cost flow in the manufacturing environment. So when your direct materials, direct labor, and manufacturing overhead are put into production, it will not straight away turn into finished goods. It will be in work in process while it's still being worked on. And once it's completed, it goes on to finished goods. And up to that point, it's still considered asset. Why? Because we haven't sold the finished goods and therefore it has future economic benefit. But once these goods are sold, then it goes on to an expense account called cost of goods sold. Other terminologies that you might want to review are prime costs and conversion costs. So prime cost is simply direct material plus direct labor, whereas conversion costs, as the name suggests, are the costs incurred to convert raw materials to finished goods. So they will include direct labor as well as manufacturing overhead. Managers need estimates of product costs for different purposes. So in financial reporting, for example, we need the cost to determine the cost of goods sold and also to value the inventory on hand. And in a manufacturing environment, there are 3 types of inventory. So again, here is another pictorial representation of the manufacturing cost flow. We have here what we refer to as inventoriable costs. These are the same as product costs, all right? They are assets. So your direct materials, direct labor, and manufacturing overhead, when they are put into production, will turn to work in process first and then later to finished goods. All right. Now, in the balance sheet of a manufacturing firm, you will find that there are 3 types of inventory. The work in process inventory is one, the finished goods inventory, and of course the raw materials inventory. Those materials that are not yet used into production. So these are all shown in the balance sheet because they are part of the asset, the inventory. All right. Now, once goods are sold, it will actually be transferred to an account called cost of goods sold. And so it will be shown in the income statement. All right. And so, of course, you know, sales minus the cost of goods sold will be equal to your gross profit. Now, what about those upstream and downstream costs in the value chain? Do you remember the research and development costs, the design costs, the supplier costs, the marketing, distribution, and customer service? All those costs are actually shown in the income statement as part of period costs, the expenses. All right. So they are your selling and administrative expenses. And once you've, of course, deducted the selling and administrative expenses from the gross profit, you get the net profit. Now, that is the normal way we present our income statement for financial reporting purposes. And we will realize later on that that format of income statement is the absorption costing format. So we'll get to that in a few slides. All right, so what about this schedule of cost of goods manufactured and the schedule of cost of goods sold? Well, if you can't remember how do they look like, it actually looks like this. So schedule of cost of goods manufactured should have your raw materials used, your direct labor, and your total manufacturing overhead. When you total that up, that would be your total manufacturing cost. And if you do have work in process beginning balance, you'll need to add that. And if there is any work in process ending balance, you need to deduct it to get to COGM, cost of goods manufactured. And the schedule of cost of goods sold would look something like this. Finished goods inventory beginning balance plus the cost of goods manufactured from the cost of goods manufactured schedule here will be added there. And that would give you the cost of goods available for sale. When you deduct the ending finished goods inventory balance, you will get the cost of goods sold. So hopefully this is looking like a review to you. If not, then please go through this on your own. There are several cost classifications that you should have been familiar with. For example, costs can be classified in terms of cost behavior. They could either be variable or fixed. All right. In terms of traceability to the cost object, cost can either be direct or indirect. That's why we have what we call direct labor and direct materials. Indirect would be your manufacturing overhead costs. As to controllability, you should have controllable versus uncontrollable cost. And we've already looked at the value chain, so you'll remember this. Manufacturing or product costs, we've also just reviewed that, the direct material, direct labor, and manufacturing overhead. And as to the timing of expense, you've got the product cost, which are assets or inventoriable costs, and you've got the period cost, which are expenses. All right. Let's move on to learning objective 5. We'll revise variable costing and absorption costing by preparing an income statement using both absorption and variable costing. And we will reconcile the differences in the profit calculated under absorption and variable costing. By the way, variable costing format is also the contribution margin format. So let's start with absorption costing. You've already seen how an income statement format looks like. That is normally the one that is used in the financial reports, and that is absorption costing. So absorption costing is a system of accounting for costs in which both fixed and variable production costs, that means manufacturing costs, are considered product costs. So in absorption costing, we calculate the product cost by adding the fixed manufacturing overhead costs as well as the variable manufacturing costs. So what are variable manufacturing costs? This includes your direct materials, direct labor, and variable manufacturing overhead. What about variable costing? It's a system that only assigns the variable costs of production to products. So to calculate product cost, we only include the variable manufacturing cost, direct materials, direct labor, and variable manufacturing overhead. In the absorption format, this is how it looks like, right? Revenue or sales minus cost of goods sold. We just put it there, full COGS. It means it's the full manufacturing cost of goods sold, equals gross profit minus period cost equals profit. In variable costing, the format that we'll use is revenue or sales minus variable cost of goods sold. That means it's just the variable manufacturing costs, this one here. And we'll also deduct the other variable costs. So that would include variable selling cost, variable administrative cost, if any. Then we will be able to calculate contribution margin. So again, contribution margin is simply your sales revenue minus variable cost equals contribution margin. Then we deduct fixed costs, and that would give us the profit. So just to recap, the only difference between absorption costing and variable costing is in the way we treat the fixed manufacturing overhead costs. So let us apply this in this example. Timberlake Company had the following operating data in their first 2 years. So the variable cost per unit are provided here. They have direct materials $3, direct labor $2, and variable manufacturing overhead $1. Total of $6. Fixed cost per year is manufacturing overhead of $120,000 and selling and admin $163,800. The production and sales are provided here. In year 1, they produced 30,000 units and sold 26,000 units. In year 2, they produced 26,000 units, but they sold more, 30,000. How's that possible? Well, in year 1, they produced 30,000, sold 26,000. So they have 4,000 units in their ending inventory in year 1. From zero inventory to 4,000 inventory at the end of year 1. So their inventory in year 1 increased. In year 2, they only produced 26,000 units, but they still have 4,000 from year 1. And so they sold all of their inventory in year 2. No inventory at the end of year 2. All right. So their selling price per unit is given at $24. Let us do some preliminary calculation. Under absorption costing, in year 1, the cost per unit will be the variable costs of all these total $6, direct materials, direct labor, and variable manufacturing overhead, plus the fixed manufacturing overhead. It is 120,000 and we produce 30,000 units in year 1. So that means it will work out to be $4 per unit in fixed manufacturing overhead. So $6 variable manufacturing overhead plus $4 fixed manufacturing overhead, that would give us $10 per unit under absorption costing. What about under variable costing? Well, it's only the $6 because remember that under variable costing, we exclude the fixed manufacturing overhead. So let us present the income statement under absorption costing. So in year 1, sales was for 26,000 units multiplied by the selling price of $24 per unit. That would give us 624,000. Minus the cost of goods sold. Cost of goods sold is how many units were sold? 26,000. How much is the cost per unit? $10. So 26,000 times 10 is 260,000. Gross margin, therefore, would be 624,000 minus 260,000, 364,000. Then we deduct the selling and administrative expense of 163,800 and we'll get the net income in year 1 under absorption costing as $200,200. In year 2, we sold 30,000 units at $24 again. So that would give us 720,000. Then we deduct the cost of goods sold. So the calculation of cost of goods sold in year 2 is a little bit complicated. Why is that? Well, we have left over from last year, year 1. How many? 4,000 units. At what cost? $10. So that's 4,000 times 10, $40,000. So that's that. Then in year 2, we spent the variable manufacturing cost of $6, right? So $6 times how many units did we produce in year 2? 26,000 units. So $6 times 26,000 will be that part there. And because this is absorption costing, you also have to include the manufacturing overhead that is fixed, 120,000. So we are putting that one here. You might ask, well, why don't we just multiply it by $10? It's because in year 2, the cost per unit will not just be $10 because we only produced 26,000 units. So by right, you should divide $120,000, the fixed manufacturing overhead, will be divided by 26,000 units. All right? And then you'll add it. But there's no point. We'll just add the full amount of 120,000. All right. So the total of that is $316,000. And that's the cost of goods sold under absorption costing. So we'll get 404,000 gross margin once we've deducted that from the sales. And then we deduct again the selling and administrative expense of 163,800 and we'll get net income of 240,200. All right. Now, over the 2-year period, when you just add all that sales, cost of goods sold, and the net income, of course, you'll get 440,400. So now let's move on to variable costing. The sales under both variable and absorption costing will be the same, 624 and 720,000 for year 1 and year 2 respectively. But the cost of goods sold will be different. Remember, we have sold 26,000 units in year 1 and our cost under variable costing is $6. So we'll multiply 26,000 by $6 and that's 156,000. And we have no variable selling and admin costs, so therefore we can calculate the contribution margin right away. 624 minus 156,000 is 468,000. Then we'll deduct the fixed costs per year. Fixed manufacturing overhead of 120,000 and fixed selling and admin cost of 163,800. So we'll get net income of 184,200. In year 2, we'll calculate cost of goods sold. We've sold 30,000 at $6, so that's just 180,000. Contribution margin is simply the difference, 540,000. And then again, we'll deduct the fixed manufacturing overhead and fixed selling and administrative costs to get the net income of 256,200. When you total up both columns, you can see that the net income under absorption costing and variable costing for the 2 years total are the same. But in terms of the net income for year 1, they are different. And also for year 2, they are different. Why is that? Because whenever there is a change in inventory, the profit under absorption and variable costing will be different. So whenever your production is not equal to your sales, there will be differences in profit calculated under absorption and variable costing. So this time, we'll learn to reconcile the profit between absorption and variable costing. All right, focusing on year 1, when there was an increase in inventory. Remember, in year 1, we produced 30,000 units, so production is greater than sales. We only sold 26,000 units. When the production is greater than sales, profit under absorption costing will be greater than profit under variable costing. Why? Because there is an increase in inventory. All right, and you can see that in year 1, absorption costing has 200,200 profit, whilst variable costing only has 184,200. There is a difference of $16,000. What happened in year 2? When there was a decrease in inventory. Remember, in the beginning of year 1, we have no inventory. At the end, we have 4,000 units in inventory. In year 2, we have 4,000 inventory at the beginning, and at the end, there was nothing. So there was decrease in inventory. All right. So when this happens, it's actually when production is less than sales. We produced 26,000, but we sold 30,000. So when production is less than sales, then the profit under absorption costing will be less than variable costing profit. And we can see that 240,200 is the profit in year 2 for absorption costing, but under variable costing, it's 256,200. Again, there is a difference of 16,000. All right. Notice that over the 2-year period, we produced 30,000 in year 1 and 26,000 in year 2. So that's a total of 56,000. What about the sales? Well, we have 26,000 in year 1, 30,000 in year 2. So a total of, again, 56,000. So in the 2-year period, production and sales are equal. So when production is equal to sales, there's no change in inventory. And therefore, profit under absorption and variable costing will be the same. So when there's no change in inventory, remember, when we started year 1, we have 0 inventory. When we end in year 2, we have 0 inventory. So there was no change. All right. And that's why profit under absorption and variable costing are exactly the same over the 2-year period in the total column. All right. Now, how do we reconcile this? There's a shortcut to reconciling the profit, and that is to calculate the difference in fixed overhead and the change in inventory. So in year 1, how did we get that 16,000? Remember that our fixed overhead cost per unit, 120,000 divided by 30,000 is $4. In year 1, how many units did we have in inventory? From 0 to 4,000, right? So 4,000 change in inventory multiplied by the fixed overhead per unit of $4, that would give us the 16,000 difference in profit. That's the shortcut to reconciling the profit. It's the change in inventory, 4,000, times the fixed overhead per unit, $4. All right. Now, the question is, how does variable costing income provides a better measure for managerial performance compared to absorption costing income? Well, look at the effect on profitability of using absorption costing. Absorption costing can be used actually to manipulate profitability. Why? Because when we use absorption costing, which is the one that is required by accounting standards for financial reporting purposes, when absorption costing is used, we are deferring fixed costs in asset account, in the inventory. Whereas under variable costing, we are expensing all the fixed cost, whether it is manufacturing or non-manufacturing, we're expensing it. In absorption costing, part of the fixed manufacturing overhead is capitalized in the inventory. It's counted as asset. All right. So by increasing production, more fixed cost will be left in the inventory, which is an asset. Therefore, less fixed cost will be transferred to cost of goods sold expense. What would be the result? It will result in higher profit. And is that good? Well, it's not exactly good for managerial performance evaluation purposes. If I'm the manager and I would like to show a good profit, all I have to do is to manufacture more, even though I know there's no demand for that. Why? Because I can capitalize, I can defer fixed costs as part of inventory and therefore less expenses for the year. But the problem with that is there will be a build-up of inventory. If year after year after year, I keep on producing more even though there's no enough demand, what will happen is that those inventories might become obsolete. And if I resign already after 2 years, for example, that's no longer my problem, right? I can show that I had good profitability during my term, but that's not exactly good for the company. Variable costing is less susceptible to such kind of manipulation. Why? Because all fixed costs are expensed out in the period in which they are incurred. There will be no capitalizing of this fixed manufacturing overhead cost in the inventory. Also, variable costing is consistent with cost volume profit analysis. So CVP includes all fixed costs to compute the break-even. Variable costing and CVP are in that way consistent because both treat fixed costs as a lump sum. Absorption costing, on the other hand, as we have noted, defers fixed costs into inventory. And so absorption costing is inconsistent with CVP analysis because absorption costing treats fixed costs on a per unit basis, which could be at times misleading. All right, so in terms of evaluating both absorption costing and variable costing, we can say that both have advantages and disadvantages. Absorption costing is advantageous because fixed manufacturing overhead is treated the same as the other product costs like direct material and direct labor. It is consistent with long-run pricing decisions because in the long run, the company must cover the full cost. And for external reporting as well as income tax purposes, they require absorption costing. However, as what we've already mentioned, absorption costing includes unitized fixed manufacturing costs, which can lead to erroneous decisions. And it could encourage managers to improve their profit by building up inventories. What about variable costing? Well, management finds it easy to understand. It's consistent with CVP analysis. It emphasizes contribution in short-run pricing decisions, which could be useful for tactical decision-making purposes. The impact of fixed costs on profits are emphasized, and the profit for period are not affected by changes in fixed manufacturing overhead. However, in longer term, a business must really cover its fixed costs. Therefore, many managers prefer to use absorption costing, particularly in cost-based pricing decisions. And furthermore, it is sometimes difficult to classify all costs as either fixed or variable. All right, as another illustrative example, we will discuss problem 8-32. The first requirement here asks us to compute the product cost per container of frozen yogurt under variable costing A and B under absorption costing. Firstly, let us calculate the predetermined fixed overhead rate. So that is fixed manufacturing overhead that is given here is $300,000, and we'll divide it by the number of units produced, 150,000 units. So the fixed overhead rate per unit will work out to be 300,000 divided by 150,000, $2 per unit. So now we can calculate the product cost per unit under variable costing. They told us that the direct materials, direct labor, and variable overhead are $5, $2, and $3 respectively. So we'll just add that, and that gives us $10. That's the variable cost per unit. And since we've already calculated here that the fixed manufacturing overhead cost per unit is $2, we'll just add that $2 to $10, and that would give us $12. That's the cost per unit under absorption costing. So we are done with requirement 1. Let's go to requirement 2. Prepare operating income statements for 20X1 using absorption costing and B, variable costing. So let's start with absorption costing. It says here that Skinny Dippers sold, even though they produced 150,000 units, they sold 125,000. So sales would be 125,000 units times the selling price. How much is the selling price? Is given here at $15 per unit. So that comes up to 1,875,000. Then we'll deduct the cost of goods sold. We have already calculated here that the cost per unit under absorption costing is $12. So 12 times 125,000, that will give us 1.5 million. So we can calculate that gross profit is 375,000, and then we'll deduct the selling and administrative expenses. It says here that the variable selling cost is $1 per container sold. So $1 times 125,000 units sold, that would give us 125,000. And the fixed selling and administrative cost is 50,000 per year as given. So 375,000 minus 125,000 and 50,000 will give us $200,000 profit. And that is under absorption costing. So now let's go to variable costing. Sales would be the same, but the cost of goods sold will just be the variable manufacturing cost, and that is this $10 per unit. So $10 times 125,000 units will give us 1,250,000. We will also deduct the variable selling and administrative cost of $1 times 125,000. So that's 125,000. So now we can calculate contribution margin. Sales of 1,875,000 minus the variable manufacturing cost of 1,250,000 and the variable selling and admin cost of 125,000 will give us contribution margin of $500,000. Then we'll deduct all the fixed expenses. The fixed manufacturing overhead cost is 300,000 as given here. We'll deduct it there. And the fixed selling and administrative expense of 50,000 will also be deducted. That would give us operating profit under variable costing of $150,000. Let's now go to requirement number 3. We are asked to reconcile the operating income reported under the two methods by listing the two key places where the income statements differ. We can see that, of course, the cost of goods sold is where it differs. Under absorption costing, we've calculated cost of goods sold as 1.5 million. Under variable costing, we've calculated the variable cost of goods sold as 1.25 million. Giving us a difference of 250,000. Where else did these two income statements differ? It also differ in terms of the fixed manufacturing overhead of $300,000. So when we deduct 300,000 from the 250,000 difference in cost of goods sold, we will get that 50,000 difference. And that is exactly the difference in the profit reported under variable costing, which is 150,000, under absorption costing, which is 200,000, thereby giving us negative 50,000. So that is requirement 3. What's requirement 4? It's asking us to reconcile the operating income reported under the two methods using the shortcut method. So when using the shortcut method, the formula is simply the change in inventory multiplied by the fixed overhead per unit. So notice here that we have produced 150,000 units and sold only 125,000. So there is an increase in inventory of how many? 25,000 units, right? So that change in inventory of 25,000 units will be multiplied by the predetermined fixed overhead rate per unit, which we have calculated in requirement 1 to be $2 per unit. And so that gives us that $50,000. That's the difference between the profit reported under absorption and variable costing. All right, so that is it for this lecture. I'd like to end by sharing with you this Bible verse found in Proverbs chapter 18, verse 9. It's a reminder for us not to be slack. We're just starting the semester, and so if we start right, I'm sure we will end right. It says here, one who is slack in his work is brother to one who destroys. So hopefully we will not slack up. This also reminds me of this favorite quote of mine. It says, if you want to make an easy job seem mighty hard, just keep putting off doing it. And so I hope that you don't put off the work that you're supposed to do, not only in this course, but in your other subjects as well. Let us pray. Our most gracious Heavenly Father, thank you so much, O Lord, for being our God who loves us so much. I pray that we will not slack up, that we will continue to work hard in order for us to be able to use the talents that you have given us, not for our own glory, but for your glory, O Lord. Help us to be able to do our best and help us to surrender all to you. In Jesus' name we pray. Amen. All right. So don't forget to do your post-lecture required activities, and I'll see you in class shortly. Bye-bye for now.